Good afternoon, everyone. This is Nakul and Pooja joining in from Equanimity Investments. Uh, it's good to be on this platform today on this sunny afternoon, and it's a very pertinent topic that we're going to discuss today on business models that are generally favorites of venture capitalists. Both Pooja and I, our day job involves working with founders, working with early stage ventures. So we look at multiple types of business models, multiple types of businesses, sectors on a day-to-day basis, and we've tried to jot down a few pointers, few takeaways that founders on this call can mull upon going forward in terms of what works for a venture capitalist, how do venture capitalists evaluate different kinds of business models, why are they attracted to a certain type of business model, and what are the negatives of the others. So we'll basically develop upon these points over the next, say, 25-30 minutes. Idea is to leave you with some food for thought as you build your organizations for the next few years and eternity thereafter. So hopefully that's the target that we are working with. So what we're trying to do here is uh, basically speak about each of the features and each of the aspects of different business models, and then of course we'll take up Q&A. So at the end of the session, so please, if you have any kind of questions that are cropping up in your mind as and when we're speaking about different business models, please feel free to drop in the questions in the chat box in the app, and we'll take it up post our conversation. So good afternoon, Pooja.
Good afternoon and hi everyone.
Yeah, great. Pooja, before diving into our topic for today, what I thought was would be a little more pertinent for our founders here is to understand what venture capital is, right? So, see, every investor has a different vantage point. You're a venture capitalist, you are looking at investments from a different angle. So, it would be helpful for our audience to understand who is a VC, what does a VC do, and why does a VC look at a business model the way he or she looks at it, right?
Yeah.
So if you could just decouple it a little for our founders, it would be really helpful to them as a context.
Yeah, sure, Nakul. So hi everyone. I think what is key or what differentiates a venture capital investor from any other investor investing in, say, mutual funds or listed markets is the whole tenure that they kind of look at when investing in a particular company. We are here for the long haul. It's not that we are going to invest and look for liquidity in, say, a few months or a few days or even a year. So we are here for a 5 to 7 year tenure. And the kind of business models that attract us is, of course, we come in early. So there are a few very two things that are, a founder really walks on a tightrope, like what do you do, like growth or profitability. So if you would ask me the kind of models that I would like as a VC, it would be both high growth and high profitability. You ask me, then I want the moon. But it's a bit of a balance that one has to maintain. And I think during our conversation, we'll talk about some of the aspects or the traits in a particular model that will help you kind of achieve both and also, bring about that scalability, which a venture capital can also back. And also the fact that, we come in early, Nakul, we always, it's a high risk bet that we make. So there has to be a high return expectation as well from the companies that we invest in. We expect 10x odd returns. So because there is a risk of, company going zero altogether, your investments going to zero. So these are the kind of return expectation and the tenure, the traits that we look at from a VC perspective.
Got it. So good, Pooja. So this basically helps us in terms of understanding that a venture capitalist is an early stage investor. He's coming in with a appetite of high risk and therefore an expectation of high return. And that's why we would look at a certain business model with a certain different eye, right? So let's deep dive into the topic for today in terms of understanding what are the key features, what are the key traits of a good business model that we really like, right? So one key thing that we all in our office keep thinking about is कि बस scale कहाँ से आएगा, right? What the key moot point is scale.
Yes.
So let's double click on this point,
Sure.
which is the most important point in our understanding
Yeah.
for an early stage venture to get the returns that we are expecting, right?
Yeah.
Scalability.
Yeah.
So some thoughts there.
Yeah, sure. I mean, see, scalability comes in from a large market size. India being such a populous country, and with different strata of income segments, middle income, low income, high income, there is a large potential for companies to come in and build products catering to all these segments. So even when we are evaluating spaces, so spaces like, say, a logistics, it's such a large, unorganized, age-old industry, but again, a very large industry and a market to cater to. Even within logistics, when we look at companies, right, there are different modes of transport. So road being the highest contributor. In fact, at Equanimity, we have been looking at companies which are solving and bringing more efficiency in the road transport. Another example I could say in the retail side, like e-commerce, and Flipkart has been a decade old now, but even then the penetration of e-commerce is just some 10 to 15%, not more than that. So if you see that the market and the scope, the scalability scope is so high because of the whole population and the increasing spending capacity of the population. So I mean, these are the few examples of some sectors that I think can bring in scalability. So we always look at the market size. And what I would like to add is, it's not just about whether the market is large now, but it is also important that the market is large and is even growing at a large, rate of growth.
Yeah.
So that is very key. Like, for example, if I take EVs, right? It's everyone is talking about EVs. But it's still a growing market. It's a niche market. But if you just see the last 3 years, there has been like a 200% average year-on-year growth, in the sale of EVs. Of course, we are starting with a small base, but the growth has been crazy, right? And we want to be a part of the wave, considering the tenure that I was talking about, like 5 to 7 year tenures. So we take these early bets to see, which are the markets that have that potential to become really big. So it's not just a large market that will bring you scalability, but also a large rate of growth that will bring you that scalability in the business.
Fair enough.
Yeah.
No, that's so. Maybe I can reframe our thoughts over here. When you are evaluating Pooja, a particular startup, the startup claims that it's a scalable business model, and as you said, India में तो सब कुछ ही scalable लगता है ना, because India is such a large market. Then how do you break it down in numbers? How do you do that top down, bottom up analysis जो बोलते हैं सब लोग? If you could just give us some understanding around that.
Yeah, so I think there are two ways to identify the whole market. One is, of course, like you said, the top down. There will be various reports that are done by large consulting firms that will give you idea about how big is the market right now and how what has been the CAGR, like the compounded annual growth rate in the past few years. So that will give you an idea of the growth rate on that market. But if you see, even bottom up analysis is very critical for us.
Yeah.
Like, we don't want to just rely on secondary reports, because that considers the entire country. Maybe that is not your targeted addressable market. So we talk about this SAM, SOM, and TAM, right? Like, there has to be a particular market that you can ultimately cater to. It's not like your product is going to be sold to 130 crore people of India, right? It has to be a particular segment in that. So I think that bottom up analysis to kind of understand how many people are actually going to use your product, or would aspire to use your product, and then second, how many will be able to afford the product. I think that bottom up is very important in any segment that we are looking at.
Fair enough. I think that's very critical for founders, where you have the clarity in terms of what you are targeting, how big is the market, not just from a top-down billions of dollars numbers point of view, but really understanding how many customers can your product be sold to, right?
Yeah, so absolutely.
Fair enough. So moving on to the next point that we keep looking at again from a business model perspective is innovation, right? So innovation and technology. As early stage investors, as tech investors in the ecosystem, why do you think this becomes a critical factor? Why do you think this is a key piece in a business from a founder's angle as well, right?
Yeah. These are both very critical points. Now, I'll tell you some reasons as to why this is so key for an early stage investor and for a startup. Like, we see, there are a lot of problems to solve for in the country. but the capital access is not as much. So, your Reliance and the Tatas of the world can take up like, large projects which are capex heavy, and they can even get to the end of it. But as a startup, you don't have access to as much capital. So what becomes very important is the use of innovation and technology to bring about that scalability or a hockey stick growth that one wants to see, right? Another important aspect, the innovation aspect that you're talking about, I think that really helps. So one is the whole tech piece, that because of limited capital, you need to have the technology to bring the scale. But one is that innovation, why it is also important is that helps you build that sustainability moat around your business. Like, for example, we have this portfolio company, Rene. Now, Rene Cosmetics has, innovation is at their core completely. They were the pioneers to have started the Fab 5 in one stick, which is 5 lip colors in one stick. And any product that they launch, they have innovation at their core. So that makes them, they have that first mover advantage. The customers also think, okay, there's something interesting that they would come up with all the time. So I think that helps you build around a moat around your business. So it's not just for scalability, but also for building that sustainability. Both innovation and technology are key.
Fair enough. That's a very pertinent point from a moat angle that you're making, Pooja, here. See, again, as investors, one is, and as long-term investors, one is looking for that sustainability in the business model, right? So today I invest, I am not looking at cashing out in a 2 to 3 year period. I'm looking at being with the company for a long period of time, and that's where this moat, I think, becomes critical.
Yes, absolutely. Yeah.
So also, one thing that keeps coming up in our talks is sunrise sectors, right? That's another term that we keep using internally. I'll give you an example. Recently, we were discussing about one of the EV deals. So we've again been a very active investor in the EV ecosystem in India. We have a portfolio call out that I can do is Neuron Energy in a portfolio, which is doing really well. Basically, an EV battery manufacturer, and then moving across the value chain now going forward. But we're looking at EVs as one of the biggest sunrise sectors from an India perspective. There is a transition to clean energy which is happening. EV is, of course, electrification is, of course, at the forefront of that. And there is a lot of capital that is required to build the infra as well as the market for doing that, right? And that's where funds like us, investors like us are very important that and looking at those returns as well. So, do you think these sunrise sectors offer that kind of the innovation quotient, the more the scalability that we're looking at? Is that a business model that you would be really looking forward to?
Yeah, absolutely. Like, these sunrise sectors are the ones that link it to my earlier point about the whole scalability and the market size. The market is small right now, but it is growing. Then I will be investing in that. And of course, if we are putting in money and we are seeing innovation, because even in EVs, there are so many enablers and so many business models. There are OEMs, there are battery manufacturers, there are BMS tech guys. So all these players, they have to have some kind of innovation in innovation play in what they're building to be able to actually go to the next stage. Like this money that we put in, when we come in at an early stage, we'll put in the initial capital that will take them to some level. But if they're not using, they're just like another Me Too, another general business, then it becomes difficult to raise the next round. So I think it will be for these sunrise sectors as well.
Got it. Good. So let's be on the lookout for founders who are building in these sectors, right?
Yes.
So moving on. See, next we spoke about scalability, we spoke about innovation. One more key piece that comes across from a business model standpoint as an external investor is repeatability, right? So we love that. We love certainty. So let's hear a few thoughts around that in terms of what makes repeatability or certainty in a business model attractive to an investor.
I mean, so many. The poster boy for the whole repeatability would be B2B and SaaS businesses, right? So many VC investors love investing in SaaS. So many investors are focused on investing in SaaS because a SaaS business will give you that recurring, revenue that brings in a bit of certainty in the whole uncertain ecosystem, so to say, that we are a part of. So that is definitely a positive to see. In case of B2C models, I would say it's more of maybe in terms of users, we kind of track the retention rate. So not necessarily that you will, because B2C, you're not going to get as repeat like it is in a classic SaaS or a B2B model. But in B2C, what we've been tracking, like the D8, that is the retention data of the users, like how many users who are coming on day one have been being retained by the company on, say, a day 15 or a day 30. So that retention ratio really helps us in tracking how good a repeatable business model is. So I think these are some points I would like to.
I'll double click a little on this repeatability that we spoke about, right? So as VCs, again, you're looking for metrics, and as founder, I'm always looking for, hey, what is the right metric? How much should I achieve, right? So if you could, there are certain metrics that keep floating around in our ecosystem called as LTV, CAC, and AOV. So just let's decouple that a little.
Yeah, sure. So let's take as an example, like it's coming out in the news recently, like quick commerce player, your Zepto, Blinkit, Instamart, they have now started out with larger ticket items, like they've been selling phones. I also heard someone saying that they've been selling cars on the platform. I don't know how true it is. I've not checked. But why are they doing that? Why are they selling high ticket value items on their app? Because they need to recover, the revenue from the same customer. So LTV to CAC, all the startups who are in the B2C space, they aspire to have a 3+ LTV to CAC ratio. And it's in order to achieve that, because you're getting a customer, you're doing marketing spends, your CACs are really high. And then they're just purchasing, say, 100 grams of tea, or, just some small item, which is, the average order value is too low for them to not even recover their customer acquisition costs, make it very expensive. So it impacts on the unit economics, and maybe we can delve on it a little later. But I think these are some of the terms. When you talk about LTV to CAC, 3+, is like a good metric for a B2C company to track. I think even another example that I can think of, when you talk about like good repeat business or recurring business, like let's take example of the fintech space, right? Like there have been a lot of these new age fintech companies in the credit card space, or even as a credit card business, right? Once you had like a reasonable base set, you don't really have to invest a lot in getting new users on a month-on-month basis. You have issued your credit card to good quality, good credit users, and then they will keep increasing their spend as they use it on a month-on-month basis. They will keep increasing, and that's going to increase your revenue. So it's such a brilliant model, that attracts a lot of VCs overall to the fintech space as well.
Fair point. So that's a very critical point in terms of monetizing from the same customer base that you've already acquired, right? So essentially increasing your wallet share with the same customer base, and not just growing your customer base month on month, right? So both are important. Growing your customer base as well as going deeper into the customer relationship.
Pockets,
Fair enough. So that speaks about a little bit about the repeatability, recurring nature, the certainty around the business model that we're looking for. A related point here that again keeps coming up, and which is very much spoken about in our ecosystem today, is capital efficiency, right? So we of course the 21 era, we've all become investors which look at the bottom line also along with the top line. So that again is a key feature of the business model. How should founders think about it? What are the key things that one should build upon? Because we are again at early stage, right? So we are all cognizant about the fact that we may not be profitable today, but what happens next?
Yeah, I think, like you rightly said, off late it has become, not off late also, now it's been, the funding winter has been there for more than a year now. And I think the entire ecosystem is now talking about unit economics, capital efficiency. But I would like to highlight that at Equanimity, we have been focusing on capital efficiency since inception. In the companies that we invest in, if we don't see them making profits at operational level, then it just becomes very difficult for them to even reach that EBITDA profitability in the near future. So we always look for companies when we are evaluating, we look for the detailed unit economics, whether they are making profit on at least at gross levels, because then I mean, if you're not achieving that, then it becomes very difficult to even show to the new investor who's coming on board that how capital efficient you have been. And I think even one more thing in capital efficiency that I see a lot of founders make mistakes sometimes is that even before the right product market fit is achieved, they raise like small angel rounds, and then they make these really expensive hires. Now that is impacting the capital efficiency also, because you have this amount of capital and then you would rather spend it on acquiring more users or building your sales team, or rather building team which is more related in terms of having a variable pay rather than a fixed pay, so that it doesn't strain your burn as much. I think that also is something I've seen. Founders, they get access to the capital, they think the senior team, but I think it has to be step by step.
Yes.
Again,
that's a very important point in terms of building in phases, right? So one needs to have that balance between what kind of fixed cost base you are incurring or you're building at a point in time, and what's the runway that you are having alongside that, right? So what's the general runway guidance that you provide to your founders when they're leaving?
I think now it's definitely increased. If you would have asked me back in 2018, 19, when or till 2021, which was like a big the best year, people would have said, yeah, you can, like, people have raised money within 3 months of raising the capital, so even if you are like in your burn mode, you'll still get more capital. Now I think 18 to 24 months is what you should keep in mind as your runway once you're raising some reasonable capital. Unless you're really sure that in 12 months time you will achieve those targets with some of the larger investor conversations that you've had, and they've given you some targets that once you reach these numbers we will put money into you, then you can burn, reach those particular scale and then raise. But otherwise, as prudence, because things have been slow in the market, the funding winter is still kind of extending. So I think 18 to 24 months.
Fair enough. One more point I was thinking about asking you, and I have not mentioned to you earlier. So you keep telling the founders about not spreading yourself thin. Just decouple the statement for me, not spreading yourself thin.
I mean, an entrepreneur will of course relate to it more. Like for me, I'm on the other side, and I've seen this trend amongst a lot of founders. As a founder, you're so passionate, right? And there are different opportunities that come to you, like even if you're doing like B2C and you've got this big B2B order, then you will have that, okay, it's going to increase my top line, so why not go for it? But sometimes what happens, it comes at the cost of diluting your existing offering. So if I see monetarily, it will impact your runway, because it will strain your working capital. Sometimes, so I've seen in our own portfolio, there have been cases where they have been selling to mid-sized clients, and then they get this large order from a really enterprise customer, and they take that up because that's giving a bump into their revenue, but then it's impacting their working capital because it's straining their balance sheet. The payment cycles are really slow. So then you kind of get stuck. Like as a startup, you cannot afford to have any kind of strain in your balance sheet. You have to be very nimble in terms of recovering capital. I mean, recovering your money from your customers. So I think spreading yourself things monetarily, this is how one needs to be important. One needs to kind of be thoughtful about. Otherwise, I feel it's more like even like there are companies which are present in certain geographies, or there are companies or startup that just start in a particular city, say Mumbai or Hyderabad, and then or they have a certain product offering which is say a tool for sales guys, right? So we always tell them to kind of really go deep in that particular geography, or with that feature, just go really deep and build that feature well. Try to solve for what the issues your customers are facing with that feature or with that product, before you just bombard them with new features, or before you try to just expand to multiple geographies, go pan-India. It's an aspiration, of course, I understand. But if your base is not strong, it does impact. So we always, it's not an easy conversation, but we always insist the founders to build that strong base before they really go out and expand.
That's a constant tussle between
Yes.
your founders
Yes.
whenever you are on the small because.
Yes.
Then one more thing that comes to mind, we spoke about efficiency and all, right? The landscape in which the entity or the business is operating, from a regulation standpoint, from a legal standpoint, is that also a very critical part of the business model?
Yeah, I think most VCs just kind of stay away from entities which are like or sectors which are subject to some regulations. Maybe say a crypto or real money gaming. I mean, it's not very clear. So in an anyway uncertain environment, you don't want one more thing coming up which can literally make or break a business. We have seen a lot of businesses having to pivot completely or completely shutting down because of some regulatory changes that are happening. I'm sure you have seen quite a few in the fintech space. Have any thoughts?
In the fintech space, I mean, obviously it's a regulated space and everyone has to follow the regulations, right? If you are building the right way, if you're building for the long term. But the pace of change that is happening in our ecosystem, startups have to be really nimble in terms of adopting those new regulations that are coming up. And as an investor, coming back to our earlier point of certainty, right? Uncertainty and visibility, there are these pivots that need to happen at the startup level, which may or may not be very comforting to an investor. So that brings me to the last point. We spoke about all these tangible aspects, right? Of the business model. We spoke about innovation, repeatability, efficiency. You can have a form factor around that. But what is the critical factor?
It's the founder. Always. It's the founder.
Exactly. So we back the founders, right? We back the guys who are able to have the ability to pivot, to build that business through those uncertain environments, right? So I mean, how do you do that? And what's your
I see that I would be steering a little away from our topic, but we need to see, our topic was mainly to talk on the business models, but honestly, at early stage, especially when we come in, right? It's we've been writing about it since a long time that whether it's the jockey or the horse, Equanimity is always going to back the jockey. I mean, even if you get your large market size, you are not spreading yourself thin, you're focusing, you're also being kind of capital efficient, not burning too much money. But if the founder doesn't have that execution capability, or that passion, to go big, and I mean, I think just boils down to execution in India in any business model. So if that is not happening, then even if you take all the check boxes, I don't think you will get that recipe of success, if I may say so.
Fair enough. Good. Super. So I think, Pooja, we've covered quite a bit of ground. Maybe we can look up the questions, see what's piling on. And as we do that, so I'll just give some more context around the business models and how VC is evaluating, right? So, see, as founders, we are building businesses, but as VCs, we are looking at making a return on investment. So it's the two vantage points. How do VCs make returns? There are two factors through that, essentially growth. Or multiple expansion. This is getting a little technical, but I'm just trying to decipher it for our founders here. If a business model that is growth oriented, like coming back to our first point of scalability, if it is growth oriented, it is growing at a good 20-25% year-on-year growth, at least at the growth stage. A VC will have the comfort of making money out of it because there are returns to be made at that stage.
Right.
So that's one factor that is critical.
Absolutely.
And then there is multiple expansion, which is basically today when I invest at a certain price to sales, price to earnings multiple in a particular company, which essentially means the perception that I as a VC have of the founder and the business that they're building. Tomorrow, if the market has a better perception of that, today I'm valuing the company at a 5x multiple, tomorrow it will be 8x multiple, 10x multiple. So the same number of customers, the same revenue will be yielding more returns for me. So founders should think about these two levers from an investor standpoint that I'm looking at, right? So just build on your businesses in such a manner that you have both these levers fighting for you,
Yeah.
growth as well as multiple expansion.
Yes.
And then I think it will become easier for convincing the VCs to come on your cap tables and provide you that fire of capital, right?
Yeah. See, it's so easy to raise capital. Just tick, 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 and done. Yeah.
Easier said than done.
We have some questions, so
Sure.
we want to take some of these questions. So let me start with what is Equanimity's approach in selecting potential investments by Aman?
So Aman,
Speed, yeah.
we covered a little about it in the conversation that we had, but essentially it's a framework that we follow. We call it as field framework, wherein we are looking at startups from all these scalability, capital efficiency, innovation and technology at the early stage. We are looking at, we lastly spoke about the founders, right? So we're looking at experienced founding teams, teams who have the right to win, that we call ourselves, or we calling it that way internally, wherein they're coming with relevant backgrounds and experiences that give them the right to win in the space that they're building in. So these are some of the critical factors that come together. It's not one factor at all. It's a culmination of all of these that are formed in the investment decision-making process. And then it's an institutional process. So we have an entire team of investment along with our partners and the IC, which takes this call in terms of doing that crystal ball grazing and hoping that we invest into the next unicorns of the world, right?
Yeah, that's good. Then are there any particular industries or sectors where you find yourself more drawn to? Any certain types of business models? If so, why? Or any emerging trends? The next question is emerging trends or business models that you find yourself, you particularly
Sure. So again, from a business model perspective, all the factors that we discussed are something that we would look at and we get attracted to, right? But we can speak a little bit about the emerging trends in our ecosystem and in our early stage ecosystem. So we spoke a little bit about those sunrise sectors from an EV standpoint. We're looking at EVs in a very positive manner because the market is expanding. The market is in very niche market right now, but has to be completely replicating the auto sector eventually. Then we're looking at a lot of deep tech solutions which have that high innovation quotient, but eventually will solve large problems for large markets. So looking at deep tech in a very important and a critical manner. Gen AI is building up, right? So that's again an innovation-led technology. Today it's pretty nascent. We're seeing a lot of chatter around. There's a lot of funding going into it, but still, from an evolution standpoint, the company or the technology is pretty nascent. So, as early stage investors, one would definitely look at investing into that and building real life use cases for Gen AI and solving for that, right? And of course, our traditional sectors of consumer tech, health tech, fintech, those are large areas and large opportunities from an India perspective. So they keep continuing to be our favorites, and we are investing big time on all of them. Yes. Do we have time for more questions? Maybe we can take up one more. We've already crossed 5. Considering your experience, are there any common pitfalls or red flags in business models that you make you cautious about potential investments? I think, Pooja, you're well placed to answer that. I think whatever we said, right? Like kind of not spreading yourself too thin, not bringing about capital efficiency or being at least operational level from day one, being positive, retention. These are some of the things that you need to be, I think, careful about when you are, or the metrics that will make or break a business, even from evaluation perspective. One more thing that I've seen in a lot of these 0 to 1 journeys that I've been privy to, one critical factor that we don't speak about as much in our ecosystem is the organizational culture. Right. So the organizational culture and the hierarchies and how we are building the org structure, that becomes a critical factor of scaling a business, right? So if you have a good business model, if you have everything in place, and you don't have culture, you don't have the org to build that, it won't be a success. So that's again a key ingredient to be put into the soup to make it happen. In fact, you answered one of the questions because someone had asked what are some of the metrics that often gets ignored, and I think this does get ignored. Like we at Equanimity spend a lot of our founders before we make an investment. We not only meet with the founders, but also, go and meet with the team. And that gives, like Nakul rightly said, gives us some kind of flavor about how the culture is.
in the company. And I think it all trickles down from the founder's thought process, right? And it's not like anything is drastically going to change post investment. So I think these are some of the factors which sometimes get ignored. Are those not metrics, but these are the softer, intangible aspects that get ignored but shouldn't be.
Perfect. So thank you for listening to us, and please reach out to us on our social media channels for any queries and proposals that you are building. Would love to engage and would love to see what we can build together and find synergies, right? And hope to leave you with some food for thought that you can build upon.
Yeah. Thank you so much, guys.
Thank you. Thanks a lot.
Yeah. Bye.